Hello guys, today we are diving deep into something that could completely transform your expiry trading strategy. We are going to learn how to predict expiry in markets using three powerful indicators: open interest data, max pain analysis, and put call ratio. Before we interpret this OI data any further, let's make sure we all understand what open interest actually is. Open interest, or simply called as OI, represents the total number of outstanding derivative contracts that haven't been settled yet. Unlike volumes, which tracks daily activity, OI tells us how many contracts are actually being held. Before we get deeper, take a moment to explore our other trading videos on our homepage and make sure you are subscribed with notifications on. So let's take this Nifty for example. Here 24,800 has call open interest of 74.57 lakhs and put open interest of 46.57 lakhs. So what this actually means is 74.57 lakh calls has been newly written and they are being held. They have not been closed yet. So this says that this many call writers are confident that the prices won't go past above this. At the same time, put writers 46.57 lakh put writing is there. So these many people are confident. So this is the overall OI data. But if you look at the same time 12th June, the call writing and put writing might be different. So this is the overall call writing for any kind of intraday movements. We also need to check for the intraday change. So if you look at even intraday 24,800, there is a good call writing, nearly 34 lakh of call writing versus put writing of 11.68. So these put writers, they might have hedged positions, and because the call rating is higher than the put writing, we can confidently say at that point of time call writers are strong and they are not allowing the prices to go above this 24,800. As you see, even the price action has confirmed somewhere on Friday. Prices have made a high at 24,801, but then immediately sellers stepped in, pushing the prices downside. By tracking continuously this call writing, not only the whole day, by looking at from 15 minutes and 30 minutes and last 1 hour, we'll get much better idea how the institutional traders who have more capacity to move the markets, they are positioning themselves in the derivative market. When you look at on overall daily time frame, this could be high, but when a sentiment changes, you will see often on 5 minutes, 10 minutes, or even in 15 minutes put writing starts increasing. That is where even on price action you will see some kind of upside breakout. There will be a strong short covering. So this is one way, guys. Open interest tells you the support and resistance levels for the day, but as you get closer to expiry, like on Monday, Tuesday, Wednesday, you will see this call writing on put writing, they becoming stronger and stronger day by day. So remember, OI alone doesn't tell you any kind of direction. It only shows initial positioning of the big players. That's why we need to combine it with our next indicator, the max pain theory. Let's talk about max pain theory, one of my favorite expiry prediction tools. Let's understand what max pain is. Max pain is the strike price where option holders or option buyers collectively face the maximum loss. This idea stems from option sellers are more powerful than option buyers. They always try to pin the market into an area where option buyers face maximum loss. So this is what actually most of the time happens. So if you look at here, the max pain as of now is 24,800. This is on daily time frame. This max pain itself continuously change as the expiry approaches. Higher time frames, max pain has more significant impact. To give you an example of importance on this max pain, last expiry 29th May, around 12:30, prices had made a low below 24,700. At the same time, max pain was around 24,800. I thought there is a high possibility prices will turn around immediately at 12:45. there was a sudden up move and the prices have closed about 24,800 levels. So the settlement value itself might be much lesser because the expiry value is taken based on the weighted average price of last 30 minutes of expiry day. Now let's understand put to call ratio. What this basically PCR tells you is ratio between put options and call options traded over specific period of time. A high PCR means more puts are being purchased, indicating bearish sentiment. A low PCR suggests bullish sentiment. So here the PCR value of 0.81 indicates for every 100 calls being traded, only 81 puts are being traded. So this speaks about a slightly neutral or a little bullish sentiment. So PCR when combined with other OI data and max pain theory, it's a strong sentiment indicator. So generally a low PCR of below zero point 0.5 or 0.6, it might indicate bullish sentiment, and high PCR of 1.2 to 1.5 may show highly bearish sentiment. But at the same time, these two values below 0.6 or 0.5 and above 1.2 or 1.3, that may tell us that prices are going in overbought or oversold zone. So once the prices go far below 0.6, it means there is a possibility turnaround might be there. To understand this PCR value better, go into historical data and try to establish the extreme values for each and every index or each and every stock. They have a PCR value which is baseline. If you can establish that baseline, once the prices goes to that baseline, you will see a sharp reversal in the market. So in that sense, this PCR will be much useful. Combine this with open interest and combine with max pain, and more importantly use this with price action, demand or supply areas. So there you have it, a complete system for predicting market expiry. Remember, no prediction method is perfect, but this approach gives you a significant edge. If you found this video valuable, what's coming up next? It will further enhance your trading skill. Don't miss that. Until next time, trade smart and stay profitable. Thank you guys.